Have you ever heard the advice a penny saved is a penny earned? It's one of those classic sayings we all grow up with. And it's true, saving money is incredibly important. It's the foundation of financial security. It's your safety net for emergencies, your fund for that new car, or the down payment on a house. But what if I told you that by only saving, you're actually losing money every single day? It sounds crazy, right? But stick with me for the next few minutes, and I'll explain why relying solely on saving will fail you in the long run, and what you need to do instead to truly build wealth. Let's start with a simple thought experiment. Imagine you managed to save up $100,000 10 years ago. You worked hard, you were disciplined, and you tucked it all away in a standard savings account. You'd feel pretty good about that, right? That's a significant accomplishment. But what can that $100,000 buy you today compared to what it could have bought back then? The price of everything has gone up: gas, groceries, housing, education. That $100,000, while still a lot of money, has significantly less purchasing power now. This sneaky, silent wealth killer is called inflation. Inflation is essentially the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Central banks around the world typically aim for an inflation rate of about 2 to 3% per year. It might not sound like much, but let's do the math. At a 3% inflation rate, your money loses about half of its value in just 24 years. So that $100,000 you saved? In 24 years, it will only be able to buy what $50,000 can buy today. You didn't spend a dime, but you lost half your money. This is the fundamental flaw of just saving. You're fighting a losing battle against an invisible force that is constantly eroding the value of your hard-earned cash. Your savings account, with its tiny interest rate, if any, isn't even keeping pace. It's like trying to run up a down escalator. You're putting in the effort, but you're either standing still or slowly moving backward. So if saving isn't the answer, what is? This is where the crucial shift in mindset comes in. From a saver to an investor, saving is playing defense. It's about protecting what you have and being prepared for short-term needs. It's absolutely essential. I want to be clear on that. You must have an emergency fund of 3 to 6 months' worth of living expenses tucked away in a safe, liquid savings account. That's non-negotiable, but building wealth? That's playing offense, and the way you play offense with your money is by investing. Investing means putting your money to work for you. Instead of letting it sit in an account getting eaten by inflation, you use it to buy assets that have the potential to grow in value over time and generate more money. Think of it this way: when you save, you have your money. When you invest, your money starts having babies, and then those babies have babies. This magical effect is called compound growth, and Albert Einstein supposedly called it the eighth wonder of the world. He said, "He who understands it earns it. He who doesn't pays it." When you just save, you're on the paying side of that equation. Now, I know what some of you might be thinking. Investing is risky. I could lose everything. I'm not an expert, and the stock market seems complicated and scary, and you're not wrong to feel that way. There is inherent risk in investing, and the media loves to sensationalize market crashes. But there is also risk in not investing, the guaranteed risk of your savings losing value to inflation over time. The key is to understand and manage the risk, not to avoid it altogether. You don't need to be a Wall Street guru or spend all day watching financial news. For most people, the simplest and most effective way to start investing is through low-cost index funds, or ETFs. Let's break that down. An index fund is a type of mutual fund that holds a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index, like the S&P 500. The S&P 500 is simply a collection of the 500 largest publicly traded companies in the United States. So when you buy a share of an S&P 500 index fund, you're not betting on a single company like Apple or Amazon. You're buying a tiny slice of all 500 companies. This immediately gives you diversification. If one or two companies do poorly, it has a minimal impact on your overall investment because you have 498 other companies that are likely doing just fine or even great. This is the #1 rule of managing investment risk. Do and put all your eggs in one basket. Historically, despite all the crashes and recessions, the S&P 500 has returned an average of about 10% per year over the long term. Let's go back to our $100,000 example. If instead of putting it in a savings account 10 years ago, you had invested it in a simple S&P 500 index fund, what would it be worth today? Assuming that average 10% return, after 10 years, your $100,000 would have grown to over $259,000. That's more than double your initial money. While your saved cash was losing its purchasing power, your invested cash was not only beating inflation, but was significantly growing your wealth. That's the power of investing. That's how you play offense. Another concept we need to talk about is opportunity cost. Every dollar you keep sitting in a low-interest savings account beyond your emergency fund has an opportunity cost. That's the potential return you're giving up by not investing it elsewhere. Let us say you have an extra $20,000 just sitting in cash because you feel it as safe. If the market returns 10% that year, the opportunity cost of keeping the cash on the sidelines was $2,000. You didn't technically lose $2,000, but you failed to gain it. And over a lifetime of saving instead of investing, these missed opportunities add up to a staggering amount of potential wealth that you never got to build. The goal is to find the right balance between saving and investing that works for your personal situation and goals. It's not an either-or proposition. You need both. First, build that emergency fund. Get it fully funded. Once that's done, every extra dollar you save should have a job. Is it for a short-term goal, like a vacation next year? Keep it safe in a high-yield savings account. But if it's for a long-term goal, like retirement in 20 or 30 years, that money needs to be invested and put to work. The best part is that getting started has never been easier. There are tons of apps and online brokerages that allow you to open an account in minutes and start investing with as little as $1. You can set up automatic transfers from your checking account every payday, so it becomes a habit, just like saving. Start small, be consistent, and let time and compounding do the heavy lifting for you. Don't let fear or a lack of knowledge paralyze you. The biggest mistake you can make is doing nothing. So let's recap. Saving is crucial for financial safety and short-term goals. It's your defense, but it will not make you wealthy because inflation will always eat away at its value. To build real, long-term wealth, you must invest. Investing is your offense. It allows your money to outpace inflation and grow exponentially through the power of compounding. You don't need to be an expert. You can start simply with diversified, low-cost index funds. Remember the escalator analogy. Saving is running up the down escalator. Investing is stepping onto the up escalator and letting it carry you to the top. It's time to stop just protecting your money and start making it work for you. Your future self will thank you for it. Thanks so much for watching. If this video helped shift your perspective on saving and investing, hit that like button and subscribe for more content to help you build a better financial future. See you in the next one.